Ken Lin is going to speak to us. He is from Credit Karma, the founder of Credit Karma. Actually, he got his start around the same time that Renaud Laplanche was launching Lending Club back in 2007. Ken founded Credit Karma, and he actually founded it after a conversation or several conversations with Chris Larson, who was the original founder of Prosper, remember Prosper 1.0. So this sort of brings everything full circle for me at least, and I'm super excited to hear what Ken has to share with us and his point of view from Credit Karma. So please everyone welcome Ken Lin.
Thanks, remembered. Hi everyone. Ken Lin, founder and CEO of Credit Karma. Thanks for spending your time with us today. So one of the things I'd like to do today is actually share a little bit of the learnings that we've had at Credit Karma, give you a little bit of the overview of the market in general, and 2 or 3 takeaways that we think are important in making credit scores, or personal loans, and being more competitive in the space itself. So for those of you who don't know Credit Karma, we started in 2007 with this notion that credit scores were an important metric in everyone's financial life. And back in 2007, the idea of getting a free credit score didn't really exist. There were a lot of companies that advertised it, but didn't come through. So we started the company almost 10 years ago with the idea that we could make a difference in people's lives. And our mission statement is to make financial progress possible for everyone. That's what we focused on over the years. Today, we have over 60 million users on our platform, mostly in the United States, some in Canada. We've given away over 1 billion free credit scores over the years, and we have a net promoter score north of 75 in the space. And I think more importantly to the people in this audience is we see about almost $4 trillion of US consumer debt. So we see to whom people owe debt, we see the interest rates that they pay, we see when they last applied. So I'm gonna go and talk a little bit about that overview that we have in this space. I'm gonna talk about some of the trends that we see, and most importantly, I'm gonna share about 3 or 4 takeaways that we think are really important in this particular space. So first, when we talk about market trends, we see a lot, obviously, but I want to sort of really hone in on the personal side of the business, really give you a sense of what we see and how we think that lenders can react in the space. So as you can take a look, here we just have a chart taking a look at the overall number of volume in the personal loan space since 2007. In that time period, you can really see the emergence of online lending, right? You can start seeing the little red peaks. I would say it started making a difference around 2010, 2011 when we came out of the economic downturn. And today it's a meaningful portion of overall personal loans. We've seen the number sort of really double since 2007, which is a great trend in this space. When you dig in a little bit, I think you saw the growth of personal loans, but you also see that, over the course of the last 3 quarters, that there's definitely been a decline in the percentage or share of wallet when it comes to personal loans. I think partly that's, a reflection of the lower, the funding issues that I think most people in this room are familiar with. But we actually think there are a couple other trends that are really nuanced that might be helpful as people think about growing their business. So first is something that's maybe not as intuitive, right? So what we did was we wanted to take a look at the average weighted APRs for sort of near prime and higher credit scores. And what you can really see is part of the problem that we talked a little bit about from a funding perspective is in play, but you also really see the uptick in overall cost of borrowing, right? The weighted average APR of loans in the personal loan space has really started to increase over the course of 2016. You also see that in banks as well, but when you see a 300 basis point difference between what the online lenders are charging versus what the banks are charging, that becomes very competitive, and that can be part of the reason why you see a declination in the overall share of volume in this space. Another trend which is actually driving the increase in APR is really the default rates, right? So when you take a look at defaults by credit score, this is, you can see that online lenders have actually historically performed worse in more recent cohorts when it comes to the overall trend. Obviously, they compress and get much more competitive at the higher end of the credit spectrum. But my note here is I think as volume has dried up or potentially dried up, people have gone lower into the credit spectrum, and the differential in underwriting, the differential in defaults has been quite costly when it comes to default rates and lower ends of the credit spectrum in the personal lending space, online personal lending space. And we see that across the space, but here, when you take a look at this problem has been exacerbated, I think, in the more recent cohorts. So when you take a look at 2014, 2015, and you look at the overall delinquency rates, so this is global 18-month delinquency rates for 90 days plus delinquent for 3-year term loans, you can really see that online lending, the spread in the actual default rates has increased quite a bit over the course of the last year, year and a half. This is obviously some of the more aged data, but you can see that trend, and I think that's one of the widening differences that you see in the space, which might cause a little bit of alarm, and we think there's some ways that you can mitigate some of these things. And then lastly, you can take a look at these trends, again, by cohort, weighted by score. The older cohorts tend to be the ones that are on the darker lines, so the top red, and you can see that sort of generally speaking that credit quality and performance has actually been getting worse over time as you look at the various cohorts controlled by credit score. So a lot of data here, a lot of focus on the fact that as a whole, the industry is growing, but rates are increasing as a direct response to the fact that the performance of these loans have not been as good as they've been in the past. So keys to success in our observations in this space. And I think there's really 4 areas that you can make money in personal loans, right, and lending in general. First is you can have a lower cost of acquisition. Second is you can have a lower cost of funding. Third is you can have better default rates. 4 is you can have lower operations. I'm going to focus on 2 areas where we think it's most important and the ones that we see most in terms of how to grow a business in this type of environment and some of our key learnings, right? They're going to be very much around the acquisition side, and they're going to be very much around the underwriting side. We'll leave the operations, and we'll leave the cost of capital for some other conversation. So I started with a very global view of what's happening in online lending. That was data across all of the United States. Now I'm going to share some information that's very specific to Credit Karma. So this is Credit Karma data now, whereas before is Equifax data across all the United States. So now we're actually, I think that the same trends that we're seeing across the US is actually very much mirrored in the Credit Karma data. Partly, I think, because we have 60 some odd million users, so our sample size is actually quite large, and we can see a lot of similar trends. So we see the same pressures that the lenders do when it comes to the overall share in the space. What's not intuitive is really what do you do about it? And one of the observations that we had is actually winning on mobile is one of the things that we highly think of as a way to differentiate in the space, right? It used to be the case that mobile was the channel of younger consumers or the channel of lower credit quality consumers. But what we observed and what we did is these 2 charts are the chart on your left is going to be the percentage or sort of an indexed share of users who are originating personal loans 760 plus, broken out by desktop versus mobile, right? And on the left-hand side, what you really see is that desktop originations has really declined over the last 3 or 4 years for us. And keep in mind, this is prime users, right? These are 760 plus loans. So, and that hasn't been the case for bank and credit unions for the most part. And what you see on the mobile side is actually where you see a lot of the growth for us, right? So point being that the demography has changed over time, and what you're seeing and what used to be that mobile were younger, lower credit scores is changing over time. We're seeing more prime users, we're seeing more people gravitate towards mobile, and we think it's really important that lenders adjust to this and really think about the mobile experience, right? That's really important. This goes back to this idea of how do you win? There's only 4 areas, right? And this very much goes to this notion of winning by having a better conversion funnel, winning by having a lower cost of acquisitions. Mobile is a way to do that. Just to show you some of the other trends again through Credit Karma, you really see that 80% of our user base is mobile now. That's changed quite drastically from the time 2013 when we last indexed it. So this is a general trend, right? As demography changes, as consumers become more and more mobile enabled, it's just critical that everyone in this room, as they think about growing their business, have a great mobile strategy, understand the nuances of mobile and how you succeed in that. Just like our overall user mix, you can actually see that back in 2013, Approximately 16% of personal loan originations on Credit Karma were from mobile, and today it's about 64%, right? So really big difference over the course of the last 3 years in terms of the way that consumers have migrated to the mobile platform. And I think that this trend will continue as we see more and more of our user base move and get more comfortable with originating loans from a mobile platform. So key two, first point is make sure you're mobile enabled, make sure you're thinking about that, make sure you understand that this is where the demography is going, but sort of the trends and the borrowers already are. The second is really always focusing on your underwriting and making sure you're building new underwriting models. So this chart's kind of interesting in the sense that we're tracking 18-month delinquency rates across our user base and those that were originated online from banks, CK originated, which are people who are from Credit Karma and then credit unions. And what you see here is that I always think about the fact that having better underwriting is challenging in the sense that math isn't all that hard, right? I mean, everyone thinks that they have the special sauce, and in many ways you do, but statistics is kind of statistics. You really can't change the law of statistics, and you have to go and find new innovative ways to underwrite better. And it's not always clear, right? If you're just using credit scores, I think you're going to have a hard time because your ability to be a little bit smarter than the person sitting next to you is actually quite challenging when you're constrained by the same data set, you're constrained by the same number of CPUs that everyone else has, and the number of cycles. So our note here is find alternative data sets and refine it, right? So think outside the box. I'll walk you through an example of how we thought about it at Credit Karma in terms of, well, great, if everyone has a credit score, everyone has the same credit report information, how do I actually make underwriting more powerful? You see a little bit of the data here that when you take a look at Credit Karma originated users, they tend to perform better than everyone else when you sort of control for credit scores. And that's a little bit of a nuance that I think exists through everything you do, from every partner relationship, from every way that you think about the analytics. And when we saw that observation, we went back and we actually tried to build a model to understand, well, what drives this type of behavior? And what we observed is that, well, behavior information on site is pretty powerful. And for Credit Karma, what we decided to do was we decided to build a model that said, okay, based on your behavior on the first 30 days of interaction on the site, can we predict what your credit score drift will be a year from now, right? So what we found was that when we built that model, we found that, well, the best performing decile, right, the best models, the best response, showed that their credit score was going to be about 50 points higher on average a year out. And they attribute attributes of coming on multiple times in the first 30 days. They were using our credit simulator. They were reading articles about credit. What they weren't doing was immediately applying for a credit product, right? Now, that seems relatively obvious, but I mean, this is my point around using non-obvious data and looking at ways that you could refine a credit model. So this is just one simple way of doing that, but I think it exists for everyone as well. So for example, as you have users come onto the site, what are their behaviors and how predictive of that is in default? If the first thing that they do is hit the apply button and they apply very quickly and don't spend enough time reading the articles or reading the actual information about the loan, that could be a pretty powerful indicator of credit quality down the road. So there's a lot of ways to broach this particular subject, but we think this is an important aspect of being more competitive in this space and making sure that you're differentiating your ability to underwrite from everyone else's ability to underwrite. 3, we think this is probably the most important piece. I think it's slightly self-serving, but I'll really focus in on it because I have a ton of passion, right? I think you really have to solve consumer pain points, right? I don't think anyone's ever heard a consumer say, wow, I wish that company had a better underwriting model, right? That's not a consumer pain point. We think that there's 3 areas where there haven't been a lot of innovation in financial services, right? And I think a lot about what's changed over the last 20 years with the internet age, with the proliferance of data. And it's fascinating to me that we've made so many innovations around things like autonomous cars. We made innovations like there are companies that are trying to put missions to Mars. But a consumer today who applies for a personal loan, on average, is going to have about a 43% approval rate. So 1 out of 2, 6 out of 10 is actually going to be declined approximately for a loan. And in an age where there's so much data, so much technology, this is fundamentally a broken area in the space. So I'd say, if you're going to solve a consumer pain point, think about ways that you can make the experience for a consumer better, right? Give them certainty so that they know they're going to be approved for that loan before they apply. Really important aspect, right? A second point and pillar around this is really around transparency. So we decided to take 10,000 random loans from the Credit Karma platform that were originated in 2016. These are all 3-month personal loans. Fascinating to me how much dispersion there is in terms of pricing, right? So we controlled for credit quality on the x-axis, and the y-axis we took a look at the interest rate of the users, right? And what you really see is that there's dispersion. So you take a look at 650 or 700, certainly there are some good people getting great deals at 10, 15%. And then there are certainly people who, again, have credit quality, 650, same exact credit quality, being charged 30, 35%, right? So you start with problem number one, this notion that there isn't a lot of certainty when it comes to applying for a loan product. And there certainly isn't transparency when it comes to pricing, because you don't actually get pricing, generally speaking, until you apply, until you're underwritten, right? That's a consumer pain point. And then lastly, I'd say focus on simplicity. That was an animated GIF, but it turned no longer animated. But when you take a look at it, you have to go and fill out anywhere from 20 questions on the low end to almost 60 questions on the high end, right? So you think about that consumer experience, you think about that journey. One, when you look for a loan product, you have no idea what loan products you'll qualify for. So that's a problem. Two, you realize there are literally thousands of loan products that you could apply for, but you don't know at what interest rate you'll be approved at. And then lastly, if you want to go through that journey and go through that exercise, you're going to spend a bulk of your time, spending your time filling out 50 questions on a phone. Not exactly intuitive. And these are the consumer pain points that we see in the space. So sort of to recap, what I think is really important in this space itself is, one, make sure you're thinking about the future, right? Make sure that you're spending time building out a mobile strategy that makes sense. I think that people think that, well, who's going to apply for a loan through a phone? Who's going to fill out 50 questions through a phone? Well, we see about 80% of our users are actually doing that, so a pretty meaningful percentage. Second is make sure you're using all data assets that are applicable. I think if you're just thinking about, your ability to charge less because you have better underwriting, but you're just using credit data, I think that's going to be challenging, right? Because everyone in this room has that same exact ability, and there's not a lot of competitive advantage in just underwriting, right? Your statistics can't be that much better, almost by definition, than someone else's statistics. And then lastly, think about the user experience. I think this is the thing that sort of most people think or miss. They don't, I think you really have to solve problems for the user to win in any space. And as I sort of go back to, no user has ever said, I wish underwriting was better, I wish you had lower cost of capital, right? They think about these things. And when you can solve these things, you can really lower your cost of acquisitions. You can really give a better experience and one that's differentiated from everyone else. So, we think about Credit Karma, well, how do we build an experience where somebody logs on and we're able to pre-screen you as a user and pre-qualify you as a user for maybe 100 loans, right? And we can tell you the rate that you're going to be qualified for because we've already done the underwriting, because we've already had the data. And when it's actually time for you to apply, you can actually apply with a thumbprint that gives consent on your phone rather than filling out the 50 or 60 questions. So that's our approach, but regardless how you think about it, I encourage everyone to think about the ways that you actually solve a consumer problem rather than a business problem. So that's what I have to share with you today. Thank you very much.